Amazing people, this is AJ Academy, and today I'm going to talk about a day trading model that I've developed. I've just observed in the market, back tested and forward tested it. So we are going to use it on GU, GPP USD, and the Euro USD. These are the pairs that I've done back testing and forward testing so far. So we are going to stick to the GU and the Euro just before we actually get to analyze other pairs, and we can see if it replicates on the other pairs. But before then, let's stick to the EU and the GU. So this model is based on 5 concepts. The concept of sessions, that is basically the Asian, London, and the New York, and then the AMD kind of price action where we have the this is the accumulation, the manipulation, and then the distribution. We are going to talk about liquidity, where liquidity lies in the market, the timing at which you take your trades. Are you going to take your trades during the London open, sessions open, or sessions close? So we are going also to mention something about that. And the bias, this is the most important thing. This is basically the direction of the market. So you need to get to know the direction. Remember, the direction is always your friend. So you don't get yourself taking trades that are against the direction you're going to be taken out. So and on our entry model, we are going to use the fair value gap. I've done a number of videos talking about this fair value gap entry model, so you can watch my previous videos to understand this fair value gap entry model. So back to the GU, we are going to describe this type of model, the trading model. And then on the Euro USD, we are going to do a deep analysis in the markets, scaling on different time frames, and then observing what I'm trying really to explain right here. And remember, if you want to consult any consultation or mentorship, you can reach me via this number. This is my WhatsApp number, and the Telegram link is on the profile. You can reach me via that. So straight to the charts. This point also on today's charts, we have okay, before we even continue, let me check what do we have here. Okay, well, so back to the daily. We are going to start, remember it's day trading, so we are going to use the daily time frame a lot. So this is the daily time frame, and this any candle that is printed right here represents a whole entire day. So this type of entry model, it's basically where key levels are being formed. You know the types of key levels that we have. Remember, my strategy is MSNR SMC fusion, but now we are going to use the concept of the key levels. You can see this level. This is basically a classical A level. If you go to the line chart, this is what it means. This is an A level. You can see this A level, it was induced, and A levels are resistance levels. So you would have anticipated that price is going to do what? Price is going to once price closes above that level, or rather you anticipated that price is going to sell from that level, because this is a resistance level. But you can see at this point, once price reached at that point, it broke above it, and now this resistance level becomes what? A support. That is basically an RBS, and that's why you can see we've had this kind of reaction from that level. This is the kind of reaction that we've had from that level. So these are resistance becoming a support. Another example, it's at this point. This is just to explain, but we're going to do a deep analysis on Euro USD. Another example is at this point where we had this support. This is a support. It has been induced, or rather this is the liquidity just above the support. But what did price do? Price closed below that support and mitigated that support and used it as a what? A resistance. So this is what we call a support becoming resistance, rather the SBR. And then another example you can see right here. At this point where I've highlighted at that area, we had a support again. What did price do? Price closed below that support. At that point, you can see that line. Price closed below, used it as a resistance and distributed. And you can see once a price has retested, it always takes out the low. It took out this low. For this case, Once price retested this, it took out these lows. So you can see it's quite a significant levels. Those are quite significant levels. So we are going to do that deep analysis, because we are day traders. Of course, we are not going to take trades on the daily. So the daily is just to give us the concept of this model. So back to the Euro USD. On the Euro USD, this is on the daily time frame. We can actually use this current price action to talk about this model, the trading model. So you can see at this point, where did price induce a key level? Where did price induce a key level? This is EU on the daily time frame. You can, if I mention or if I mark this level or I label this level, you can say this level is not fresh. Why? It's because you can see we had a rejection from that level, and we only use levels that are fresh and only have an inducement. So you can see for this level, it has been rejected, and it was trying to create a bullish storyline where daily rejects daily. You could have perhaps scaled down to lower time frames and then check for breakouts and stuff. But for this case, we are not going to factor in this level because it has been rejected. We are only going to be focused on fresh levels that have been induced. So the inducement is the concept right here. So we are not going to focus on that, and rather we are going to focus on this level. This is an OCL, basic OCL, where we had induced this level by these two candles, by this key level, the V level or the support level. It had induced this level, the OCL, and price closed below it. Once it closed below it, price closes below it, we are anticipating that price is going to use it as a resistance, and we are going to take our trades and take out this low. Remember, I told you once that has been retested, it always takes out these lows. So this could be your first target, and you could have secured about 66 pips. It's not quite a lot, but for a currency pair, that is quite good when you have a higher risk. If you could have had maybe quite a tight stop loss. So for this case, you're not going to take your trades on the daily. So let's scale down to the lower time frame and see how could you have taken a trade from that. This is just to tell you, this is an anticipation. Once price closes down below this level on the daily, you need now to go to the lower time frames like the 1 hour, the 2 hours, and see what is happening. So if we scale down to the 2 hours, what do we see on the 2 hours? On the 2 hours, okay, let's go to the 1 hour. Yeah, even the 2 hours, okay, it's just that the structure, it's very clear on the 1 hour. So on the 1 hour, remember this trade, this model I told you, it's based on 5 things, where we talked about the sessions, the AMD, and then the timing and the fair value gap entry model, and also the bias. So we are bearish because we broke what? We broke a support, and we are anticipating that it's going to be used as a resistance. So incorporating the idea of fair value gap entry model, this is where it comes in now, the idea of fair value gap entry model. What do you observe right here? Once price closed below that level, what did it form? It formed a fair value gap, a bearish fair value gap. That is basically internal range liquidity to this bearish order flow. So once that bearish fair value gap was formed, what happened? Price mitigated that fair value gap. This is the mitigation of that fair value gap at that point. It mitigated that fair value gap at that point. So that becomes our what? Remember, a mitigation to a fair value gap, and when that mitigation gives us a breakout or a break of structure, it becomes our what? A liquidity. And you can see we had a break of structure at this point. This is the break of structure that we've had at that point, right there. That is the break of structure that we've had, and then this is the mitigation. Once price has mitigated a fair value gap and it gives us a break of structure at this point, that mitigation becomes your liquidity. So that is our liquidity, and what we are going to do, we are going to find a level or a point of interest above that liquidity, and then we are going to sell from that level or that point of interest, targeting the most immediate external lows or any lows, any significant lows to the downside. So this is what we are going to do. Remember, which level do you observe at that point? We observe this level. This is a good OCL. You could have taken your trade at that level, and then this could be how you could have taken a trade at that point, stops above the week high, just above the week high, and then you could have targeted the most relative equal lows, or this Asian liquidity. You could have targeted this Asian liquidity as Asian low, or this Asian low. So either of the two, depending on your risk to reward target. So you could have gotten a 1:10, but let's have it on this initial, because we mostly target the most immediate for this 1:6 risk to reward ratio. Once it has played out, we go back to the daily. Remember, we consult our buyers, or we are day traders, so the daily time frame you have to consult it before you scale. You go to any other time frame. So on the daily time frame, what we see again, so after having that trade, remember this is the trade that we had, where is another level that has been induced? So we had this level at this point. Remember this level, it's fresh, it has been induced, and then price broke below it at that point. Where did the price broke below? You can see this was the inducement, the first inducement, and then this is the second inducement, and then price closed below. So we were anticipating that price is going to retrace back to that level, and then we are going to have more massive sells to take out these immediate lows. So what do? You scale down to the lower time frames, like the 1 hour or the 2 hours. Remember, lower time frames, I'm not going to the 15, I'm not going to the 30 minutes. Just for the concept of market structure, you need to get relatively higher time frames, like the 1 hour, to be a lower time frames. So on the 1 hour, what did I see? On the 1 hour, I observed, this is what I observed. I observed that we had these, remember this is the level that we are anticipating that price is going to react from. But on the 1 hour, what did I see? That level had already been used. Once price closed below it, it immediately mitigated that zone. A zone above it, you could have perhaps made done a refinement to this zone, which is an OCL, and then you could have continued with the sells. But now this is what happened. So the zone had been mitigated, the daily zone had been mitigated, but again, what did it form? It formed using the fair value gap entry model. That breakout had this fair value gap, left this fair value gap behind, and that fair value gap was mitigated. This is the mitigation into that fair value gap. You can clearly see there is a mitigation right there to that fair value gap. And after that mitigation, what again do we have? We have the basic model where we have our checklist is marked because we've had a mitigation into a fair value gap, and it has given us a break of structure. On the line chart, you can see a break of structure. This is a tiny break of structure, but it is a break of structure. So this liquidity, once it has given this mitigation to a fair value gap, once we've had a break of structure, it becomes our what? It becomes our liquidity, and we should look for a key level just above that area to take price, rather to sell from. And so which level is above that? Remember, this is the daily level. It's not fresh because it has been mitigated by this candle. We have this fresh OCL, so but we are going to wait for price to react from this level, which is basically another block. Yeah, the entire line, it's another block at this point on the lower time frame. So you waited for price, you can see price reacted from that level. Remember, I mentioned something about timing. On at what time are you going to take your trades? At what session? Is it on the session open or is it on the session close? So you can see this price mitigated this level. Our point of interest, we had marked this as our point of interest. You should not take a trade at this point because this is at 18. It's almost New York close. So if I scale down now, let's do the actual analysis, how you can be day trading each and every time you get such kind of structures. So this is on the 15 minutes, so that we can have the clear time frames where the market mitigated which zone at what time and time. So you can see right here we had a mitigation into that point of interest at what time? At about 18:30. That is about New York close. So we are not going to take a trade at New York almost New York close, because the market is losing its volume. It's not like it doesn't have high momentum. You can see this New York Open, this kind of price action, this was during New York Open, and we had a lot of momentum, buy momentum towards that level. But after that mitigation of that level, you can see the kind of exhaustion of price that we had. We had a lot of bars creating just for this minimum move. But you can see when we had momentum in the market, we pushed by only about 4 candles. We had mitigated our point of interest. But you can see the exhaustion of price. Price is trying to push it. Well, the sellers are trying to push price lower, but there is no volume. There is no volume. So what are we anticipating to happen? For what are we anticipating? Remember, we are bearish and we are anticipating to take bearish setups to the downside. So what are we going to do? We're going to basically use the AMD kind of price action, where we have AMD. It's basically where we have, if you are bearish, remember, if you are bearish and you're using the AMD, if you determine, maybe you've marked your ranges and you are certain that you are bearish in this kind of market, this is what you should be doing on the entire week. If weekly it's bearish, this is what you should be doing on the entire week. So bearish movement, it's this way. You have an impulsive move, and then you have sort of an accumulation, and then price manipulates higher, and then it has a push towards the downside. And then the next day, same case, manipulation, and then accumulation, manipulation, and then distribution, and then accumulation, manipulation into a higher time frame key level, and then distribution, manipulation, accumulation, manipulation, distribution. Remember, all these, it's tapping into a higher time frame key level. So we should be having some point of interest. This is, remember, this is Asian, and perhaps this is London, and then this is New York as well. This can be Asian accumulating, also Asian manipulating, and then London distributing. So it can be Asian accumulating, Asian manipulating, and then London distribution. Or at times it can be, especially during news, and then you are on a bearish trend, you can have this kind of setup where Asian accumulates, London manipulates, and then the news like NFP, we are going to have distribution during the NFP by price tapping into a key level. Remember, all these you can see at this point, this is a key level at this area, and then you can see it's sort of the breaker blocks if you've used the smart money concept and stuff. So price is going to constantly do this until we shift structure to the upside. So this is what you are going to anticipate in the market. So back to the charts. Back to the charts. Once the market mitigated or tapped into our point of interest, we needed to have a confirmation. Remember, our higher time frame, which was on the daily, was unfresh, but we marked a key level or a point of interest on the 1 hour. So we couldn't take a trade directly, and we don't take trades at New York close or about New York close. We actually trade London and New York Open. London and New York Open. For this strategy, just trade London and New York Open. Don't actually even trade on the Asian session. So this is what is happening on the Asian. We had this kind of structure where we had this lower high, and then higher high, and then this is the point at which we had a close below this shifting structure. So once we shifted structure, remember, you can see this was the breakout at that point. On the line chart is very clear, the breakout to the downside at this point. You can see we had a breakout at that point right there. This is the breakout to the downside, confirming that we are on sells, or we are bearish now. We've adopted to a higher time frame. Remember, higher time frame it's bearish, and the lower time frame has shifted to bearish. Now what we need to do is to take our fib settings. We can take our fib settings and then mark our premium zone. Remember, you don't want to sell inside a discount zone. We are anticipating to sell inside a what? A premium zone. So why did we mark this level as our point of interest? Why could I mark this level and not mark maybe the levels above these areas? So this is the reason as to why I marked that level. You can see right here on the 30 minutes. Was it on the 30 minutes or the 15? Okay, on the 30 minutes. Let me scale up on the 30 minutes. I remember these are our fib settings that we've marked from that high to where we had a market structure shift or a breakout to the downside, confirming that we are on sales, which has an alignment. So we have this kind of fair value gap. We are going to use the fair value gap and we are going to see how it works like magic. So we have this fair value gap at this point. You can observe that fair value gap. And what do we have? We have a mitigation of that fair value gap. This is the mitigation into that fair value gap. And after that mitigation to the fair value gap, it gave us what? It gave us a break of structure. If I go to the line chart, you can see this is the mitigation and then this is a break of structure. So that mitigation becomes our what? Our liquidity. So this is our liquidity. We should find a key level above it. So where should we mark our key level? Are we going to mark a key level that is inside? You can see we have a lot of key levels. We have this support becoming resistance. We could have marked it. We have also this A level, which is a resistance level. We could have as well marked it. We have also these kind of what? Fair value gap. We could have marked it. But why all these levels, all the three levels are invalid? It's because these levels are inside a discount zone and not a premium zone. Remember, this yellow line, it's our 50% level. So any level above that area, it's going to be a good premium zone to sell price from. So that's why I marked this OCL at that point, the most immediate key level, because you can see our mitigation was this, and this is the most immediate key level to our liquidity on the premium zone. So that's why I marked that. And you can see you could have taken your trade from that area. That's how you could have taken your trade, a short position from that area, targeting the most immediate external lows or the most immediate external lows. So stop loss about not 2 pips but 5 pips. Always have a stop loss of 5 pips, and then you could have targeted this Asian low. This should be your first target, and then maybe the external now low. The most immediate external low is at this point. So this could be a 1:7.94, risking 5 pips to get about 39, which is about 40 pips. So this is how you could have taken your trade. And remember, we are still bearish. So what we are anticipating in the market, it's a series of this kind of market structure where we have this accumulation, we manipulate, and then we distribute, accumulation, manipulation, distribution. So this is what we are going to look in these charts. So okay, sorry. Going back to the 15 minutes. Sorry. What am I doing? Okay, going back to the 15 minutes. Remember, after taking this trade now, you are anticipating the next day as well should do what? Should accumulate, manipulate, and then distribute. So you can see this the next day open. Remember, I told you we are not going to trade on this strategy. We are not going to trade Asian. We are just going to trade London and New York, just London and New York. So for Asian session, we are anticipating that Asian should do what? Should accumulate, and you can see right here, this is an accumulation of Asia. And then what did it do? At that accumulation, it did manipulate to the upside. Once that manipulation happened, what did price do? It again distributed to the downside. So you can see that kind of price action that has happened there. Accumulation, manipulation, distribution. Same case to the okay, this was on when? This was on a Tuesday. So on a Wednesday, what did price do? Or what are we anticipating? Because we are bearish, what are we anticipating? We are anticipating that price should do this. Price should as well, okay, before that, let me take out this. On Tuesday, or this is on a Wednesday, our anticipation is, because we are bearish, our price should be accumulating during the this Asian, and then do what? Manipulate, and then do what? Then distribute. But what did price do at this? Instead of doing this kind of price action, remember this is the we are bearish. You can see we are bearish, so we needed a manipulation, accumulation. We needed an accumulation, manipulation, and then distribution. But price instead, after the Asian session was accumulated, instead of manipulating, it kept on pushing to the downside. What does that tell you? It tells you that above this level there is a point of interest, there is a higher time frame key level that is still fresh. So what the market has done, it has created an inefficiency in the market. So we do have a concept of efficiency and inefficiency. Efficiency is a market structure whereby any order block, any key level that has been formed is mitigated before price heading to the direction that it's heading. But for a market inefficiency, it's whereby an order block can be formed, or a supply zone. For this case scenario where we are bearish, an order block, the breaker blocks can be formed and is still fresh, or it's not mitigated, and then price decides to push lower before mitigating those zones. So in mind, you should have an idea that there is a fresh level above this point that price has left behind, and in future price market is going to come back and use that level as a point of interest to sell from. It's the most premium zone. That is a high premium zone once the market does this kind of price action. So if I take out these, so remember we've mentioned that we are anticipating that price at some point in time is going to come at this level and then take. So on this day you could not have a trade using this model because you are waiting for manipulation, but instead of having a manipulation, you can see we had a straight distribution to the downside. So heading to the next day, still the same thing. You are anticipating that you should have a what? An accumulation. Same case, an accumulation. This during the Asian we had an accumulation. But now instead of having, remember we are still bearish, we are not disputing the fact that we are bearish, so we should have a manipulation to the upside and then distribution. But having in mind that the previous day, this is what the market did. The previous day, remember, the market, instead of manipulating to the upside, it did what? And it left a key level just above those, just above these highs. So on this day, this is how you could have traded. Remember, the concept is still, you can see on your Asian, price accumulated. During London Open, it did what? It manipulated to the downside. Once it manipulated, it tapped into a key level. You can see this nice key level right here. We had this kind of order block or demand zone at that point. You can see price, after this accumulation, it manipulated into that order block or the demand zone. Or you can as well, because for the MSNR, we could have marked this level, the OCL, that had been used as a resistance, price broke above, and then it's going to use it as a what? As a support. So for MSNR, that is the level that we could have marked instead of marking this entire candle as our order block. So price came back, mitigated that zone, and did what? Price reacted from that zone, and it's heading to a key level that was left behind, that to fill that market inefficiency of the previous day. So you can see right here, this is the previous day, and we are going to fill this market inefficiency. So which level? Now for the level, we are going to consult a higher time frame. So we are on the 15 minutes, but we can scale up to the higher time. Okay, let's even just scale up to the higher time frame and see which level do we have above that. Which level do we have? We have this level where we have this bearish engulfing candlestick. At this point, you can see this is the bearish engulfing candlestick. Let me take out this. Yeah, this is the bearish engulfing. So this is why you could have marked, and this is not random. I'm going to explain why it is not random. So for this trade that you could have taken from this point, remember your target could have been this area, so you could have actually leveraged taking a long trade on this day from that area, using that just the MD structure, and then stops below that level, and then your target is on that high, right there. This should be your target for 1:9. This is how you could have taken that trade. So remember, I was telling why we marked this level and we didn't mark perhaps this OCL. Remember, what do you see on the 1 hour? We have once price closed below these levels, giving us like a break of structure to the downside, what did it leave behind? A fair value gap. And this fair value gap was done what? Was mitigated. It was mitigated at this point, right here. This is where we had a mitigation of that fair value gap. If you can see, right, we had a fair value gap mitigation. That's where we had a mitigation into that fair value gap. And after that mitigation, what did price do? Price gave us a break of structure to the downside. It gave us a break of structure, or you can call it a breakout. Once it did that, this mitigation becomes your liquidity. And where is the point of interest? Where is our point of interest? We have this OCL, but again we have this bearish engulfing candlestick. So we are going to anticipate that price is going to react from this bearish engulfing candlestick, because if you scale further to the 2 hours, a higher time frame on the 2 hours, you could see if we had marked that OCL on the 1 hour, it's an insignificant, it's so random. So actually for this, we could have scaled, or we could have refined that zone to that area, and then extend, for 1:9.76. So we have a clean OCL. So this is the level that is immediately above this liquidity, this OCL on the 2 hours. So that's why you need to be also flexible with the time frames. But you can see that's how you could have taken a trade. That's how you could have taken a trade. And remember, now this is your point of interest. Let me see the time. This is the time. Remember, you're not going to take any trade at this is actually during New York Open. It's at 15:00. So during about New York Open, or an hour after New York Open. So you could have as well taken a short trade from that. Remember, you should close your trades. Why would we, our target, remember our targets, where could we have placed our targets? You're not going to place the targets right here. Why? This is so random. Where could we have placed our targets? Our targets could have been at this low. But why did we not, or why should you not target at this point? Because you can see, was the market got to this area, this was about what? 22.15. This is about market closure. And when the market is about to close, there is no volume in the market. And remember, we don't trade Asian, so that is about Asian Open. So you should take your trades out. You should secure your profits before Asian Open. So that is about 10 p.m. at night. So that's where you could have taken another trade. Remember, now you've had about how many setups? About 4 setups. About 4 setups in a span of 2 weeks. Yeah, that is quite good setups. But still continuing with the analysis. Remember, now you're coming into a new day. And remember, this kind of move was on what? This was on Friday 5th, the first Friday of the week. You know what happens during the first Friday of the week. It's NFP week. That is an NFP week. So on the NFP week, remember, we are going to use the same model. Sorry. We are going to use the same model where we have Asian accumulating and then London manipulating. So this is a manipulation of London. And why did we have this kind of deep retracement because of the news basically. So this we anticipated that we are going to have news, or not anticipating, but there was news on Friday. So after this Asian accumulating, you can see it had quite a crazy accumulation. A lot of accumulation happened right here. Price barely had any movement, and then we had this kind of manipulation where we had a significant move or push to the upside, and this was going to mitigate a higher time frame key level. So why you could have why did we have this deep retracement? So using the concept of the fair value gap, you could have actually spotted why you could or why you could have anticipated this kind of deep retracement into a certain point of interest, and then so that you can have your sales during New York Open, which is basically NFP news where they are released. So on the 5 minutes, yeah, that's the lowest time frame that we can go. That is the most lowest time frame that we can consult. Where is it? Yeah, at that point right here. So what do we see on the 5 minutes? We are going to try and map out sort of a fair value gap entry model. Remember, we have what we call fair value gap entry models. The one that we have constantly talked about. I've done an entire video, so you can I'm going to pin it so that you can go and watch the fair value gap entry. It's a good strategy. So you can see at this point we had this fair value gap before this break of structure, before this breakout. We had this fair value gap before that break of structure, before this break of structure. So this fair value gap mitigation becomes your liquidity, rather. This is your liquidity. And then this break of structure, that's the one that makes this area your liquidity. And then why did we not maybe take a level, take this point as this OCL as our point of interest, and then perhaps sell price from this level? So we have what we call, I mentioned this strategy is based, or this model is based on 5 things, and one of the things was liquidity. And but I'm presuming that you guys understand the various types of liquidity. Sorry, I'm trying to map out this. The various types of liquidity. Okay, let me do this. I want to, the various types of liquidity. Yeah, the various types of liquidity. So we have equal high, relatively equal high liquidity, relatively equal low liquidity. We have the internal range liquidities, which is in form of fair value gaps and stuff. So for this case, after marking this kind of liquidity, what did I observe above that area? I observed that there was this bearish engulfing candlestick that was formed, and before that it formed what we call relatively equal high liquidity. You can see these 3 levels, this area, yeah, this area at this point, we are having sort of equal high liquidity. So we should have marked a key level above that. And which level is that? We have this A level, which is a resistance level, and that's where we could have anticipated that our price is going to react from during NFP news. And you can see at NFP release, at NFP news release, this is what we had. NFP, remember we anticipated that we are going to sell NFP. We are going to have a sell on NFP because of this NFP. It's about 15 at 15 right here. So this is the timing. Once price, remember this is the level that we've marked as our point of interest, but the timing is wrong. This is at 12 noon. 12 noon, we are still on London session. So London is still doing what? It's manipulating. We're on the manipulation phase. So we are not going to take, you should have a good timing. This manipulation still, this is 13:30, which is 1:30 p.m. It's still manipulation. That is still London. We are going to wait until New York Open, which is at 15. And that is when news is released. That is when NFP comes out. So exactly at the open of the candle, you should have placed your cells, and then now you could have targeted. Remember the target that you could have had. The most immediate target could be these levels. These are the levels that you should target, the most immediate levels at that point. So you could have taken, this is how you could have traded news. And this system works especially with news. Once you understand the market structure, you just need to wait for Asian to accumulate and then London to manipulate. And remember, during news days, you should consider the extreme point of interest for news trading, because we are going to have a deeper retracement, because we are going to have more volume to the market at NFP or during news release. So you can see this is what we had, and that's how you could have traded NFP, and you could have gotten a good RL, which is 1:14.64, and that is it. The same thing, accumulation, manipulation, distribution, accumulation, manipulation, and then distribution. So on this case, why did we shift structure? Remember, we always consult our daily time frame. And this is because of, you can see structure shifted at this point once we got to this level. Yeah, at this point. Why did structure shift at this level? Oh, is it on the 4 hours? Yeah, I think it's on the 4 hours. Yeah, structure shifted. Remember, this is it. Oh, no, it wasn't the daily. It was on the daily, sorry. Sorry about that. So weekly, let me consult the weekly. Yeah, on the weekly. So on the weekly, you can see this is where we anticipated that price is going to kill or exhaust this sell momentum because of what you can see. If you have done MSNR, you understand that the idea of storylines where weekly is rejecting weekly, this is a bullish storyline that is being formed at this point. And then you can trickle down to the lower time frames and observe formation of things like what a breakout to the upside, and you can see you had a breakout at this point, so confirming bullish storyline. And then you can mark your point of interest to these apex levels and wait to see some reactions from that apex levels. You can see we had that apex reaction from that apex, which created a new resistance or rather support level, and you can see that's why we've had this kind of bullish push to the upside, and we are anticipating that you're going to push higher. So we've changed, or we have shifted structure, and now on the lower time frame like the 15 minutes, this is what you should anticipate, or this is what price should be doing. Now since we are bullish, this is what we are going to do. Asian accumulating, London manipulating, New York distributing, or Asian accumulating the same way, and then it manipulates, and then London distributes. Same thing another day, Asian, we are anticipating an accumulation, and then manipulation, and then distribution. So this is the kind of structures that we are anticipating for this type of movements, and then distribution. So that is basically how you're going to trade. Once you determine your direction, just wait for this accumulation, manipulation, distribution, accumulation, manipulation, distribution, and you can see it is well depicted in these charts. Once we tapped into that level, what has price been doing? What has price been doing right here? You can see we had this massive move. What did Asia do? Asian sort of accumulated. We had this Asian accumulating, and then London opened at this point. It should manipulate lower than Asian, but this case it didn't really. Oh yeah, this London, remember, Asian is this highlighted highlighted area. This is the Asian session. So, and then you can see during London open, what did it do? It did manipulate by taking out the Asian lows. It took out the Asian lows, and then we had a distribution targeting this Asian high. So on this day, this was on a Monday, so using forex.com. So this is a gap, an opening gap. This is an open gap, so it's not like a distribution or an expansion. It's an opening, it's a gap in the market. So what is price doing? This is Asian tried, because of that gap, Asian tried to accumulate, and then London, and now what we had is New York did a manipulation the same way we've had we did a manipulation before. We couldn't take a trade because you can see this is New York close, but for today, the most recent price action, we've had that kind of structure where we have had, you can see this accumulation, and then we've had this manipulation, and then we've had this distribution. So this is how price is going. So tomorrow, which is on a Wednesday, we are anticipating that today, once price rallies towards these highs, perhaps we will have an exhaustion during the New York for Asian Open, which will do something of the sort, and then manipulate, and then have a distribution. Same case, same structure, and then we push higher until we shift structure again to bearish. So that is what we are anticipating on these trades, on these that is what we are anticipating on EU. Go back test that strategy and see if it does work, but it's a good strategy. Just use it on Euro and GBP USD. I'm going to analyze other pairs and see if it truly works on other pairs. So peace out. Remember to subscribe. Yeah, any viewers, actually the viewers, I have like 1,000 viewers and minimal subscribers, so kindly subscribe. Let's get to 1,000 subscribers. Peace out.